Today we have a little bit of a little dose of alpha.
So Bryan, a lot of stuff comes up with like risk, how to price risk. I'm seeing people trying to tokenize pricing risk. What is risk? How do you price it?
That's an incredible question. I think there's like books and hours and days of content that you can just go into the definition of risk. The way that I look at it is risk has a price. I used to sell hedge funds at Sliced Investing, was like a technical guy. And the way that we look at risk was what's called like modern portfolio theory, which is this kind of displacement. Like if you have one bet in one thing, you have one shot on goal, that becomes your entire portfolio. The way that started to look at risk when I was working with these hedge fund guys was effectively there's a curvature and there's risk reward, a risk of going to zero, risk of going to the moon, and then everywhere in between. And so as you build out a portfolio that you want to last a long time, risk is really about how you place your investments. What are the expected returns? What are the expected losses? And then aligning that to your goals.
Yeah, I'm used to risk being a board game, but
Nice, dude.
no, we think of risk versus reward. The idea that with higher risk, you have higher opportunity for reward, but then different risk profiles or different like mandates for different types of investors. It's like if you have a 20% shot of winning the lottery and it pays 100x, then it's like you do want to place the bet, but with how much? Because you have an 80% chance of losing everything. And so there's even something can be plus EV or high above net zero expected value and still not be a good play. Something could be negative EV and be a good play based on the risk profile of protecting assets you have or protecting deals that exist. There's a reason insurance came up separate from government mandates for different things. But what types of risk do you see in DeFi? And how does that differ from what's available in TradFi?
Yeah, I think the biggest one is smart contract risk. There's like 4 or 5 types of risk. First is governance. The major one is smart contract risk, getting hacks, things along those nature. And then you have tokenomics risk. Like, will the token provide value to the protocol or does it actually create an attack vector? Smart contracts, the people behind it, the governance, the tokenomics. Yeah, I think especially in DeFi, also oracles, pricing risk. So like where are you getting your data from? Those are like the main risks. Very specific around lending protocols. There's 3 types of risk. There's smart contract risk. There's configuration risk, how you place the interest rate curves, the supply, the collateral, the LTVs, and there's oracle risk. Those are the 3 main risks in a lending protocol. On a DEX, it's a lot of people get wiped and arbed out like pretty quickly. And those things, if you have like a standard thing, but smart contract risk is overall and arching the thing that people are most scared about. Security, security, security.
Yeah. The idea of DeFi where we're able to automate and have finalized or have finality really quickly and efficiently brings up all kinds of new types of scares. Where in TradFi, it's like you're trusting people, you're trusting systems. There's jail time available, but also like the government can be the ultimate debtor where bankruptcy is possible if things kind of hit the fan. But then when you start getting to DeFi, the automatic settlement is like, well, if there are Oracle mispricings or whatnot in TradFi, then they'll freeze it, they'll stop it, they'll be like, hey, that's not right. They'll revert it. And that can't be done in DeFi. It's just, oh, you just got absolutely wrecked out of nowhere at no fault of your own.
And it's gone.
And it's gone.
And it's gone.
Yeah.
Yeah. I mean, look, decentralization has a premium, right? So if you want to have like a global ledger and a global currency across the world and everybody get to act, and you want it to be truly yours, that you're kind of have to play that game. And one of these risks are that, right? So there's kind of like a debate about, centralization, decentralization. In traditional finance, you have paper contracts, you have Uber lawyers. They've standardized most of these trading contracts and these loans to a degree where people can trade the same paper over and over again. So you don't even have to basically go through this, right? So it's like in a case of this scenario, we all know which judge is going to go to or which court is going to go to, how they're going to proceed, who did what in the contract, and it's done again and again and again. So it's kind of been commoditized. So even though they do have paper contracts, plus there's reputational risk in traditional finance, you really don't have reputational risk. Well, you have brand, but reputational risk is a huge thing. Will people trade with you in traditional finance? In DeFi, you kind of don't care, right? So, which brings a different type of risk, which is like legal risk. Are you trading with a terrorist organization?
Yeah.
You don't always know.
It's been interesting watching DeFi speedrun TradFi over the last, 5-6 years, where now we're creating, we started with M0 with USDC, and now we've got M2, M3, M4 coming out with, commoditizing deposits on money markets, and then take those and create loops with them, tokenize the loops, and then borrow against that, which becomes a line of credit. Like all of these things that exist in traditional finance, but have taken a lot longer to create and are being done now by a lot of people who weren't educated in what's been done in traditional finance. What other similarities and differences do you see between what has gone on for hundreds of years and what we're speedrunning?
I think size matters, right? So even on big deals, traditional finance is probably still the way right now. I mean, it's order of magnitudes bigger. The whole entire DeFi space, last I looked, was like 160, 170 billion, right? It's kind of small potatoes. I think the main difference is like access, right? We are building the system. We are building the rails. We are building the future still to this day. And it is early. But, once you get to like $1 trillion, it starts to become hardened. We know how to do things in DeFi. Traditional finance has, if you look at the stock market and kind of like, Lloyd's of London, insurance, and these types of trading posts, it's got like 200 years, 300 years of like experience, right? That's a lot of experience. That's a lot of mistakes, a lot of people getting wiped, knowing how to do things and know how to do things differently. I love that you say that we're speedrunning because we're making all the same mistakes. Like hopefully we make less of them, but we are making a lot of the same mistakes that traditional finance made over the course of 300 years. And we're like, oh yeah, no, we don't need to do it that way. And then just like the hammer comes down and it's gone.
Yeah. And when it comes down, there's no bailouts. There's no too big to fail. Here in DeFi, we operate with a zero-sum game, whereas in TradFi, they operate with a negative-sum game, where there are these bailouts and the entire countries can assume the debt of your mistakes and you can just go back on, try new things. So do you think we'll ever see some kind of government bailouts or some kind of protocols on chain?
Did you see the questioning to the Treasury guy this week? So a senator or congressman asked him on one of these meetings, will America bail out Bitcoin? And the Treasury guy was like, I don't understand what you even mean by this. He's like, no, will the American government ever bail out Bitcoin? And I'm like,
dude, Bitcoin's going bankrupt. What's the CEO going to think?
Exactly. So we are in the dark trenches of an ugly market this past weekend. And I think we lost 25% of the market cap of Ethereum in the last 7 days, which is like insane.
Gold, that can happen in one day. So
yeah, we're in strange times here. I don't think there's any flight to quality. Like the flight to quality that was essentially there before is becoming less and less. Which I think is healthy for like the economy, right? Because you have to take these risks. You have to bet on the future. You have to bet on different protocols. You can't just sit in money market funds and print ad infinitum forever. I mean, some of that is good. When there is no flight to quality, flight to safety, what you basically have to do is go more risk on, and that generates the economy and it gets people to take better risk into venture, better risk into new companies or roll-up strategies, private equity, these types of things. I got a question for you, Eric, if you're ready for the next topic.
Yeah.
What's the difference between gambling and investing?
Yeah.
What's the difference between gambling and investing?
Love it. Yeah, gambling and investing. My background's in gambling, doing it as an investor. So usually the only real difference is the assumption of EV or expected value. So both you're risking money to win more money. You're using money as a tool to get more, except with gambling, the expectation is that you lose or that it's negative EV. That's the connotation that comes with it. Whereas investing, you can lose, but the expectation is that over time you're going to win. So back in the gambling side, the difference between playing blackjack and card counting is card counting, you're using a specific system that's plus EV. The more you play, the more money you make. You take plenty of losses on the way, but eventually you get banned not because you're making money, but because you're expected to make money. Then with investing, if you're, investing in crap coins, or say you're investing in silver a week ago and now you're down 20%, you were investing because you thought you were going to make money. Fundamentally, you lost because you were gambling. The only difference is expectations.
So not quantifying by percentage, that seems very subjective to the individual, right? Somebody could believe that they're an investor and they're really a gambler or vice versa.
Yes, most gamblers believe they're investors. Most investors like to think they're not gamblers.
Yeah, unless you're completely like a professional and you're like delta hedging every aspect of what you do, there's some semblance of gambling in there, right? Or like managing that risk.
What I've told people for a long time, like with a background in casinos and in gambling, is that everybody is a gambler. Most just don't realize it. You take a gamble when you walk down the street, you take a gamble when you buy a car, and then there's the safety ratings, but how safe are they? When you choose to drive or fly, it's like everything you do has risk associated. It's just a matter of what works, what doesn't. And so risk is everywhere in life. And then we try to hedge it, whether you're shorting the token that you have a whole bunch of to create some kind of balance and protect principle, whether you are paying car insurance or life insurance. Like if I die, my family's at a whole bunch of risk. And so I want to have some kind of hedge and pay for protection for them.
That's right.
Yeah, there's risk in everything. Everything's a gamble.
It's interesting. Or an investment.
Or an investment.
And the next walk down the street, I'm going to say, this is a good investment.
Yeah, if I buy enough life insurance, then...
Yeah, it's definitely an investment. That's really cool. I was expecting more of an answer around like percentage quantification. I guess the percentage quantification really comes around the EV. And then there's kind of like different scopes of like EV, right? So there's your personal calculation of EV. Then there's kind of like what, maybe your friends or colleagues at a company may expect from as EV. And then there's kind of the scope of like larger within your industry and then the world. It becomes like this really interesting structure. While you may think it's positive EV and you could prove that it's positive EV, that's where kind of the contrarian bets come into play and the gambles come into play. Where the rest of the world sees it as negative EV, but you see it as positive EV.
And similarly, the concept can change based on like more meta versions or derivatives of EV. So you might choose to lose money slowly over so much time, knowing that you're able to preserve purchasing power or other types of power. Or you might be like, hey, I'm fine having negative EV compared to this, but I want it positive compared to this optionality. So you can consider losing money more slowly or just general less volatility. So I guess volatility would also be something that separates gambling from investment. But again, there's different types of risk profiles for different types. I mean, all the different VCs that we'll talk to or portfolios will have their own mandates that they're going for. And some are very risk on. A lot of VCs want 1 out of every 10 bets to go 100x, but they don't want every single one to 5x.
Yeah. And the link in this video, we should put like, am I a degenerate gambler? There's this quiz that you can take. And it's got like 15 questions, and how you answer it says whether you may or may not have a gambling problem. We should throw that in there. It's fun.
I've
had like 8 of like 15, and it's like potentially it's a.
When I was actively card counting as my primary job despite employment, I met with some of the founders of like 1-800-GAMBLER and was talking to them about it. And it's like, I show signs of at-risk gambling, but I also do this to make a living. They're like, we really haven't run into this. So yeah, it's interesting.
Yeah, trading risk, I mean, especially around like different token plays. I mean, I don't trade meme coins. I haven't for 4 years. It's just doesn't make sense. It just is. It's too risky, right? But some like interest rate plays and interest rate arbitrage is a lot of the games that we play in, and then building some structured products and vaults. Let's get into some of the risk around some of the products that we're building and figure out if this seems too risky or not for individuals.
Yeah. So one thing that I see us running into a lot as we're working with money markets and CDPs and building structured products is kind of this risk around time or risk around liquidations. So if you're doing secured lending, especially with automation where, it's based on oracles, it's not based on, as many paper contracts, then you have this risk of how long does it take to liquidate? How do we get the money available to ensure liquidations? How long does it take to liquidate based on different size and capacity? And then working with different partners of different size to kind of itemize this where, hey, maybe 1 week is okay for this size. Maybe 1 day is okay for this size. But a lot can happen in a day, as we saw on October 10th.
Yeah, a lot of this, my eyes have especially October 10th, but as the RWAs come on chain, the redemption and time duration risk is essentially there. I think you'd hit the nail on the head. You have liquidations, liquidators. How much can they handle? What capacity? What's the time duration risk? We're remapping the entire infrastructure of how people have done this for years on chain. And so thinking about, okay, well, we have liquidity pools. That's one level of risk. And sometimes we kind of categorize things in minnows, sharks, and whales, right? So minnows is like maybe up to $1 million in liquidity is on liquidity pools. Great. That can happen for global distribution. Anybody can come and play, et cetera, et cetera. That's kind of like one level. The next level is liquidations under $1 million should be able to happen on chain. You get to like the $1 to $10 million. It's like, okay, maybe there we have some time duration risk with these RWAs, being able to redeem them, get them off chain. One very popular RWA, I don't know if I should dox it or not, it's like maximum throughout the year is T+4. What that means is on a 2-day banking holiday, which happens maybe once a year or once every other year, you can have 4 days where they can't redeem. So T+4. So if you're a liquidator, you have to take on that potential RWA and then say, I'm not going to be able to become whole for 4 days. There's some other ones that are T15, T30, T90, right? So when you're kind of like calculating this, as the number goes up, so does the time duration, so does the risk. And so to compensate for that, we have that in this weird kind of the more risk, the more money, the more expected EV and APR as it goes out, the more that you have to go to traditional paper contracts and to backstop it, because we're not ready to do $100 million of liquidation. Actually, this last weekend, a protocol that I know did $44 million of liquidation, but they were like very limited amount of assets, right? Which is like amazing that it just acted incredibly smoothly and just amazing. But if you're an esoteric asset, maybe you're an asset not in the top 50 by market cap, it's going to be tough to get $40 million of liquidation across the board.
Yeah, it is. And access to emergency capital, we're seeing more credit base, more merchant cash advance, and
those are cool.
Unsecured loans coming out. But then as those get tokenized and get embedded, we get more contagions like Stream. So monitoring contagions, I always, from philosophy side, say understand your axioms, but that's also a very, very large horizontal risk that we're seeing more of. How do we mature in this space? And TradFi, a lot of times, is through insurance or reinsurance. How does crypto get to a place where more of TradFi sees it as an efficient vehicle for investing and less of gambling?
Yeah, I think you nailed it on the head, is that as you price in risk, insurance, covering just on a lending protocol, because it's very specific, you have to cover the oracle, you have to cover the configuration, you have to cover the smart contract risk. If you can cover all three of those risks up to 100 million, a billion, tens of billions of dollars, you've effectively outpriced, you've de-risked, but you've also de-risked the APR, right? So anytime that you de-risk, it's going to get a hit to returns. So if there's no risk, there's no reward, right? In the market, right? Because what we're really doing with interest rates here is like pricing risk. What is the case and probability of something that's going to get liquidated and then there's going to be bad debt, right? And as that trends towards zero, APR should trend to zero. So you have always this battle between risk and reward. And, we looked at different smart contract insurance, and there was a provider that was going to be able to provide about $50 million in smart contract insurance, but it was about 3.5%. So let's take like a USDC market. It's something like 4%, 4.5% right now. They wouldn't be able to cover $1 billion market, but they would be able to cover 3.5% of it. Now your return on investment on USDC is down to like 1, maybe 1.5%. Like, why not just throw it in T-bills? Like, why would you even mess with DeFi at all? Like, the traditional market has pricings, a mature pricing for insurance, cover, legal, credit swaps, things of these natures, but we don't have a mature market yet. So everything is charging at a premium in DeFi.
What leads that to change? And what net APR do you think it requires to be risk adjusted, and what level of risk?
It's a great question. DeFi is high APRs and it's not mature, and people are taking the associated risk to get those high APRs. The more that we de-risk it, the lower the APRs will come, and then it'll be at parity with traditional finance. So it's a pro and a con, right? And if we want more capital in, we have to de-risk. However, the APRs are also going to compress and the yield will compress. It's just the nature of the beast. And we will get more capital and we will de-risk, but the APRs that are demanding, they may be able to get them off-chain instead of on-chain. What are your thoughts on this?
Yeah, I think that the risk market is so new. The insurance market is so new that it's overpriced because it's underserved. I think that's a good niche in the market to get into right now as people are looking for better risk-adjusted returns. I agree that APRs in general are high, but then we're creating a new class of insurance. So then we're creating a new classification of insurance fraud. So the way insurance gets implemented is going to be fascinating. You can't just insure a money market like it's the same thing without understanding that if you're borrowing against Bitcoin is one thing, if you're borrowing against a wrapped stable positions in a different way, or something that could be printed out of thin air to do what some would call like an AMO, then you're in essence not doing a secured lending, but doing a secured line of credit that becomes unsecured really quickly. And that's what kind of led to the stream swap fiasco. People who were borrowing against it or who were supplying for it at 8% APR thought, hey, cool, secured lending, this is a great rate, not realizing that's actually a great rate for them as a credit product. And so getting the level of understanding as markets get crazy and you start having polymarket stuff that has or is insurance, the understanding of that is going to need to scale. And then the amount of competition and supply for it needs to scale in order to get reasonable rates. Otherwise, the risk-adjusted returns are too low and the non-risk-adjusted returns are too high. And there's this weird kind of balance that leads to us being viewed as gamblers.
Yeah, we still have more to build. I think that everybody on this watch to this point should check out your presentation for restaking last year. That was phenomenal. That presentation at ETH Denver, we should put a link in the comment below, was a phenomenal product that was created for restaking and using a product market fit of restaking as insurance. So using restaking to insure things like smart contracts, things like configurations, things like oracles. There's a lot of ETH out there, right? There's a lot of like digital assets, BTC, ETH, can basically underwrite correctly the risk of the entire market, right? They can help price it and bring like more yield products to that. So I think that is a great way to end this on insurance and reinsurance. You're always trying to pass the buck down the line and de-risk. And it's gambling. I love that definition that you came up with. The definition of gambling, whether you believe it's going to be positive EV or negative EV, and then the perception from a global basis, industry basis, colleague basis, being able to check that and when to be contrarian or not, right? And how to like test that. Other than like restaking insurance and getting more different insurance protocols, what do you think else needs to exist in the market?
I think prediction markets need to mature a lot. I think we need aggregators for prediction markets. I think we need ways of polishing prediction markets to become new types of insurance products so that we have fair markets for insurance that doesn't exist in TradFi, where everything's over-bloated, government mandated. Sure, I spew my thoughts on government mandated business in general, but that will lead to far more efficient insurance as well as what consumers actually need. So
Yeah,
I think that's
I love that idea. Staking prediction markets, there's a lot of mechanisms here that can help just internalize some of these risk components and not have to go to like dead trees and get back into traditional finance, right? Because if we're going to do this on a global basis, we have to do it on a global ledger as well.
It's hard to go from smart contracts to dumb contracts.
Yeah, once you get a taste, right?
So Bryan, for our viewers, how would you describe what went down on October 10th if they are unfamiliar or don't bring up that date in day-to-day conversations?
Yeah, other than a heart attack and a heart murmur. So crypto is maturing. And I think people took on too much leverage. So my read on the entire thing goes a little something like this. Binance had a bug in its code. And the bug in its code for about 15 to 20 minutes, they didn't allow any buys. So the only thing you could do was sell token for about 15, 20 minutes. And these were like market makers, and there's some like evidence of this, that they sell only. And because it's the largest exchange in the world, most of the oracle and the pricing is based upon Binance. So the exchange rate oracle has been deemed as like better than being able to manipulate local markets on chain because it has more volume and it's harder to manipulate. But when an infrastructure crash happens like that, and for like 15 minutes, there's no sell only, I think it was like 20%, like 15 to 20% downturns. When that hit the oracles, it created a cascading deleverage in all of DeFi. So I think gas on Ethereum went up to like $800 or $1,000 a transaction. Now imagine you have like $10,000 in a lending market and you're kind of at the edge and maybe you're like 10% down, like maybe you're at 90% LTV, right? What that means, when the 20% down, if you had 10,000 in the market, it would cost you 10% of your entire position to basically unwind and execute out when the gas went up that high. So it was a crazy travesty on like Ethereum mainnet. There were some other things. I think, a couple people blew up. And then, so what that means is that if you were a yield bearing token like Stream Finance, you had a bunch of like delta hedge neutral positions across the markets, either on Hyperliquid or Binance, on-chain, off-chain. It didn't matter. What happened was they weren't able to delever in time and get to the door and liquidate fast enough before you had a run on the bank and a cascading effect. Because once one delevering happened and the penalty happens, then it just becomes a cascading effect. In Stream Finance, I don't know what the whole entire market cap was, but It basically collapsed, and then it collapsed like 2 other yield-bearing tokens, Elixir being one of them that we knew about. And then there was a huge, after that, after the 15, 20 minutes, there was a huge depeg on Athena as well. So they're covering like, I think 10 to $14 billion at the time. I think they had a 10% depeg, right? And they were able to handle it, and they had good risk management. They weren't leveraged like less than 1x short. So they were able to handle this versus other people that might have been looped up, 2 or 3x. So that's what I think happened. A lot of people blame Athena. People blame Hyperliquid. They had this auto deleveraging or like ADL and not really really clear guidelines around it. And so Binance has, I guess, more clear guidelines. And the reason why Athena didn't get hurt worse or liquidated worse was they played the game better with the auto deleveraging. So that's what I think occurred on 1010, and it brought up a whole bunch of issues. Eric, what are your thoughts?
My thoughts are we saw fractional reserves supporting fractional reserves supporting fractional reserves. And at some point, you start multiplying fractions, they get smaller. So the idea of stream finance is people were in it because you could get high yield. You can get high yield because it's basically a credit product pretending to be a money market. A lot of these stable coins will, yield-bearing stable coins will try to get the ability to borrow against them on money markets, and then they'll print them out of nowhere to then borrow the supply against it, which is in essence credit. And they're like, hey, this is safe because only the protocol itself created these tokens, and we're happy to take on USDC at 7% because we can get 13% with it. And now we take that extra 6% and we give it to the rest of our token holders, which since most of the money's fake, the percent that goes to the rest of the token holders is actually really high, which leads to this high yield. And that does work until liquidations occur, or until there's a hole in the balance sheet, or until somebody else is able to get the free printed tokens. With Stream, the liquidations froze. It exposed the holes in the balance sheet, and basically some of the people who had curated it, because it was kind of a fund of funds, they had lost through this deleveraging. They were doing a fund of funds, not being super clear with it. So their pseudo fractional reserve was even a smaller fraction. That FUD then caused people to start exiting. The exiting led to high utilization and basically frozen markets where the people who had supplied them credit didn't get made whole during a bankruptcy. The issue is they didn't realize that they were giving a line of credit. They thought that they were offering secure lending. And that's kind of the immaturity of the space right now, where people don't understand what these high interest money markets are doing. Unfortunately, their fractional reserve was a contagion inside of other fractional reserves who allowed, say, minting tokens with USDC and Stream and 3 other types where they have kind of like broad risk, but not like systemic risk entirely in one asset. So then one blowing up caused others to blow up. And if you blow up in any capacity that's under a bunch of money markets, it leads to just cascading effects. And so that's kind of what we saw on October 10th. I think it was something like $6 billion worth of liquidations. Lots of funds blew up. And now we have the risk of a lot of the funds that did blow up have private balance sheets. And we probably don't know who all got hurt to what extent. And they're trying to save their businesses and they're trying to hide it. And so that leads to, if it's money markets, additional selling pressure on tokens, which we've seen ever since, because they need to get enough USDC to fill the hole in the balance sheet that they're not telling their LPs about.
What do you think could have prevented it?
I don't think anything could have prevented it. I know Binance might have been the catalyst that started it, but similar with Terra Luna, you'll still see people say that, oh, well, Terra Luna was actively attacked. And yes, it was. It was going to blow up no matter what. It's not an if, it was a when. I was trying to get people out. I expect at some point from the Terra Luna model, you have to factor hey, the global interest rate was 6.5% by the Fed plus 0.5% by Terra Luna. If that doesn't make sense to you, then neither did their model. And similarly, using credit products that are pretending to be secured lending is going to blow up when creditors aren't made whole. So it was a when rather than if. Honestly, I'm glad that it didn't get a lot bigger before it blew up, because more and more things were coming out built upon the building blocks that had that as a contagion. And I think it's going to happen again as we make more M1s, M2s, M3s, M4s, even if we get legal contracts backing them as legal contracts fall through, because there's not a way to remedy bankruptcies. And that's what TradFi has over us as this end user, that someday big government will come in and save the day. If we don't have that, there are just holes, and there are always going to be holes. And those get underneath the balance sheets of other products.
Yeah, I love that. We don't have a bankruptcy facilitation on a global ledger. My take is the infrastructure relied on Binance too much. Decentralization is a superpower. However, the core component of it was market rate oracles on Binance, which was a centralization risk. And I think fundamentally it's about leverage. It's about printing tokens, hyper liquid in their ADL. They create like synthetic positions. They don't have these tokens, right? So at some point in time, they are creating leverage in a synthetic format. And then how we determine the oracles, if the oracles and the most liquidity isn't on chain, and we do like this distributed compute around oracle on exchange by exchange by exchange, it's going to happen again. So it's almost a superpower to have most of your liquidity on chain, even though it's strange and weird and not necessarily profitable, and you don't have like you have global access to the DeFi users, but you don't have global access to most of the regular users are trading on centralized exchanges, Binance, Robinhood, Coinbase, Kraken, these guys. That's most of the volume. And unfortunately, as long as that volume goes to synthetics like Hyperliquid, which is now reaching tremendous, tremendous volumes, and centralized exchanges without having deep liquidity on chain, you are de-risked. You are increasing the synthetic risk, and you're increasing the centralization of oracles to the point where eventually this will happen again because the oracles will be mispriced on the centralized exchanges when the market rates during 1010 were actually correct because you couldn't get the transactions through on ETH mainnet. The right price was literally on Ethereum mainnet, but not as much volume. So do you chase the volume? Do you chase the liquidity? Like there's a balance here where it starts to make sense. And it's almost like a cascading effect. When one falls, how do you fall back and how do you fall back again to get like a maybe exchange market weighted price oracles. So I think some oracle infrastructure needs to be rethought.
Bryan, thank you for a dose of alpha on risk. Lots to consider around, even just ratio of margin trading to spot, margin liquidity to spot. The more efficient, the more scalable, the less secure. And it's going to happen again. Who's going to be safe?
We'll be safe.
We'll be safe. If you guys are interested in any of our conversations on risk, please feel free to reach out. We're talking here about a lot of the stuff that we're dealing with day to day, our thoughts on the markets, because we're actively building in them. So if you are an insurance provider, need an insurance provider, are interested in risk analysis, risk curation, this is stuff that we're working on every single day.